Hi, I'm Gary from Revenue, Real Estate Education and Rental House Profits. Make sure you click subscribe below and click the little bell to get notified of all our latest updates and top tips. Hi, so this week we're going to be looking at how to use real estate to retire. So I'm going to explain two strategies here, but there are lots of ways that you can use real estate to retire and supplement your retirement income, or help you to retire early and go pursue life goals that you want to pursue. So first thing you got to figure out is what your number is. So your number's got to be the amount of money that you're going to need on a monthly basis or an annual basis to support your life or your lifestyle. So for this number, we're going to keep it really relatively simple. We're going to just go for $50,000 a year. Okay, so $50,000 a year. And you'll notice here that I've got the chart that we're going to explain. I've got buying houses in this way and refinancing houses this way. So these are the number of years. So what we're going to do is in year one, you buy your first house. Okay, there's more videos on how to buy houses, but this is just explaining the theory. In year two, you buy your second house. Year three, your third. Year four, your fourth. Year three, you got a good house, it's got a garage. And then in year five, you buy your fifth house. Now, if you do nothing else but purchase 5 houses, and then you sit on them over 5 years, which is, if you've got a fixed rate mortgage for 5 years, you're looking to renew your mortgage. And a lot of time it comes to year 6 now, we're refinancing the first house because we've got a 5-year fixed term in this scenario. Now, when I'm refinancing my house, there'll have been a principal paid down. Now that's going to be somewhere in the region of $40,000 to $60,000, depending on if you took your cash flow and applied it down. Again, we don't want to get too deep into these strategies. I just want to explain the principle of the concept. So in year 6, you're going to take house 1 and you're going to refinance house 1, and all you're going to do is pull out the principal that was paid down. So let's round that out at $50,000. Now in year 7, you're going to take house 2 and refinance house 2 and pull out the $50,000. Year 8, you do house 3, another 50, year 9, house 4, that had the garage, oh no, it was year 3, 50, and in year 10, you're going to do house number 5. Now you'll notice that this is a cycle over time. So you're doing the first house, the second house, the third house, the fourth house, the fifth house. Then in 5 years, this is being paid down again. The principal is being paid back. So you can go back to the first house when you remortgage again or refinance and pull out the capital that got paid down in year 11. And now you're pulling in year 11, another $50,000. Year 12, house 2, and then so on, the cycle will continue. So you'll notice that there's a couple of key points in this strategy. The only thing that you're taking out of the house is the principal that gets paid down by the tenants that were in the house. Now, this could be a line of credit, this could be a remortgage. However, this could be private money. You could be using someone's RRSP money as a second mortgage. There are lots of ways of getting this money out. So don't get tied into the fact that you won't be able to remortgage. There's always a way of pulling the capital out as long as there are equity. One of the key factors that we didn't allow for in this strategy here is we didn't allow for any appreciation on the house. So if this house has went up, so in 5 years, like we said, I think the average is like 11% over the last 30, 40 years, but let's take the last 5 years. That's probably 100% increase. So if each of these houses are only worth 100,000 at purchase, and I'm just using this for math's sake, I know the days of buying a house for 100,000 are long behind us, but for the sake of proving the math concept. Now 5 years later, if this has went up 10% a year, you now have plus 50,000. Now you're not drawing this out yet, you just got plus 50. In year 7, you got plus 50, because they've each went up just 10% a year. So we haven't had a huge increase, we just went up 10% a year, but you'll notice by the time you come to refinance in year 8, you've got between $100,000 and $150,000 in year 8. How much did the house cost? 150. So now we almost have enough to add another house into whichever part of the cycle. Okay? So when this cycle continues, as we get back down to year 11 or year 12, we're now not cashing out 1 house, we're now refinancing 2 houses. So typically as people get older in retirement, their money diminishes over time, and people start, I call it bean counting. You're bean counting because you don't want to outlive your money, or likewise, some people don't want the money to outlive them. But this is a case where you've now, over time, you're increasing the annual amount of money that you can receive versus wondering where your money's gone. Now, this brings on other problems because now you've got, if you're looking to hand this down through family, now you've got to look at how you can pass this wealth that you're going to create over time onto your family. That's a positive problem now, because now you've got a positive money problem, not a running out money problem. The other thing about when you take this $50,000, if it's a line of credit or private money, you're borrowing that against the house. So that is now a debt. So when you take that debt and go spend it, that money, and again, check this with an accountant, but that money is now tax-free going into your pocket. This isn't income, this is a debt that you're borrowing against. So you can take $50,000, which you wanted as income, is potentially tax-free. Now, there are liabilities tied to the houses once you start taking money out and doing this. So when these houses sell or when they get handed down in the family, there will be a tax liability against this house. But as far as taking income to support your life or your lifestyle, this is a strategy that you can use that increases in value over time. So you're effectively doubling the houses. So you come to the next year, we're getting another 2 houses here. And then over time, in another cycle. So this is, if you retire at 60, you're now 65 and you're increasing the number of houses. At 70, you're increasing the number of houses. If you live till the Canadian average of 86, you've probably now got somewhere in the region of 10 to 15 properties that you can refinance every year that you can now pass on to your family as part of the wealth. If there's a tax liability on them, they sell half the houses, they've still got 7 houses that you can pass on to your family for the next generation. That's a strategy to help you using real estate to retire. If you've got any comments, please leave them in the comments below. Any questions, please message them to us. Subscribe to our channel if you haven't already, and I hope you like this week's top tip.